I'm Alix. Welcome to Bloomberg Commodities Edge. We focus on the companies, physical assets, and the trading behind the hottest commodities with the smartest voices in the business. Want to get right down to Data Dig, where we take a look at the top market stories of the week. First up, we got way too much gas in the U.S. So one takeaway from the oil inventory report, there's just too much gasoline supply. People are staying home. Plus, you had a drop in exports in Mexico. So that actually sent Gulf Coast cash gasoline to almost a 3-month low. That's the spread between that and overall gasoline prices. Next, you got some tin troubles. It's a good and a bad. You got global tin market just sent a warning sign. You got ballooning spreads pointing to the tightest conditions this century. And I'm talking about backwardation. So spot prices are now more than $1,000 a ton more expensive than 3-month futures over in London. And that very much points to rising demand. And finally, the oil industry got pretty beat up during earnings. But here's one other thing. Bear with me on this chart. It's busy but worth it. They aren't spending enough for a low carbon future, even though most place decarbonization at the heart of their long-term strategies. So apparently the sector actually cut investments to about $11.3 billion last year, to 4.3% of their total budgets. And that's on low carbon assets and technologies. That's according to a recent study from Bloomberg NEF. Now this color codes who's spending what. You got big European companies like Shell, BP, Total, many of which are pledging to eliminate emissions from their operations by the middle of the century. They're still the big spenders. Just them account for about 70% of the global total since 2015. All right, now let's get into the ring and stay with big oil. Fernando Valle of Bloomberg Intelligence has more now with us. Hey, Fernando, let's stay with earnings. What was your biggest takeaway?
Hi, Alex. I think the big takeaway is that most of big oil and even the refiners are ceding control to oil prices and refining margins. They're not really, they've done all the proactive measures they were going to do, cutting capex, in some cases reducing dividends, but they don't want to do any further. And they're really placing their bets on a recovery in the second half and that we have successful deployment of the vaccine. When you look at some of the spending plans that we've seen, they are low on growth, but these teams are very protective of their dividends. And when you consider just how much spare capacity you have, how much shale can come back, they're really hoping that oil will bail them out and allow them to maintain this or risk their credit rating and their ongoing cost of capital.
And Fernando, all of them try to talk a good talk about greening and the energy transition. And I just wonder, like, who is really doing the work and who is proving that they can make cash flow as they transition?
Well, certainly the Europeans have taken the lead, and BP, Shell, and Equinor have been more prevalent in green investing. But that ties into the dividend question. When you consider that the BP, Equinor, and Shell also cut their dividends, and when BP outlined their plans for investments, the investments in green energy have much lower returns in their expectations. And Bern Looney, the BP CEO, commented on their call that they don't expect their low carbon contributions to EBITDA to be positive or meaningful, at least by 2025. When you look on the other side of the Atlantic, Exxon and Chevron, they haven't cut their dividend, and their investment thesis still centers around that payout. So to increase their investments in lower return, still improving low carbon technologies, they would have to sacrifice returns on capital in the short term and then put their dividends in jeopardy.
Yeah, it's going to be a tough call for that. All right, Fernando, thanks a lot. Bloomberg's Fernando Valle. All right, time now for Commodity in Chief, where we talk to one executive in the commodity world. And this week, we're going to hear from Carter Malloy, the founder and CEO of Acre Trader. So first, though, we have to look at some safe haven trades. In volatile times, those trades are very valuable. Now, traditionally, safe haven trades are things like gold, treasuries, hard assets like real estate. In 2020, they returned 21% for gold, 10% for treasuries, and negative 5% for the REIT index. One other possible option: farmland. Its average annual return, 11.5%. Now, there are 900 million acres of farmland in the U.S. That's a lot. And 2.2 million farms producing a lot of different types of crops. And that equals $2.5 trillion in market, just a fraction of the U.S. equity market. Here's what the bulls have to say. The amount of farmland is finite. You can only farm so much, and a lot of that is shrinking due to natural erosion. Other soil can actually become less fertile the more you use it. Meanwhile, there are more mouths to feed all across the world. Plus, the asset tends to be uncorrelated to equities in economic downturns, providing some stable cash flow and less volatility. Now, to the bear case. Mother Nature. A storm, a drought can all impact current future crops, which leads to volatile commodity prices. Yeah, sure, you can hedge price fluctuations, but you're still at the mercy of the spot price. Plus, you got farmland value can be tied to interest rates, which may have bottomed, leading some to worry about overvaluations. Critics say that farms have a tough time trading above book value. Plus, there are lots of variables: regions, crop types, processing capabilities, scale, access to new technologies. Money, though, is still flowing in. Now, capital raised by ag funds hit a record $3.6 billion in 2019. That doubled from 2018. Enter Acre Trader. It tries to democratize farm investing. Now, they buy a farm, typically $1 to $3 million. You purchase shares in that farm. Each one is divided into shares equivalent to 1/10 of an acre. So if you buy 20 shares, you own 2 acres of land. You can also sell your shares on their platform, and the company raised $5 million last April. Now, I caught up with CEO and founder Carter Malloy and asked him what kinds of farms actually make good investments.
We divide the world into two: permanent crops and row crops. So permanent crops are things like trees that produce nuts or apples, as an example, whereas row crops are producing your core commodities like corn, soybeans, rice, cotton. And the two act a little bit different, or have acted a little bit different over time, though each are really interesting additions to an investment portfolio. And again, that's what we're excited about, is diversification, rather than placing all of your eggs in one basket or one type of a bet. With our platform at Acre Trader, your ability to invest, you have the ability to invest across multiple parcels.
So does it kind of work like an ETF? Like I can buy one thing and get a little bit of this farm, a little bit of this farm, a little bit of that farm?
Yeah, unlike an ETF or a fund, it's not a pooled investment vehicle. So each farm goes into a unique LLC, and you, the investor, are investing directly in that LLC that owns the farmland. And so about every week, we'll put up a new farm and allow investors to come on and take ownership in that particular LLC or farm, should they be interested.
What happens when a downturn hits? I mean, you mentioned an inflation hedge. Well, rates will go higher. That presumably will then lead to a recession at some point. What happens if the farmers can't pay?
So I'll address the can't pay question next. But first, if we look back to the most recent recessions, 08, 09 is a great example. Farmland continued to do its thing. It's not a get rich quick scheme, right? So there's never huge boom years, or, it doesn't appear there's huge bust years either. It is that slow and steady compounding of capital that we are really after. And interestingly, regarding farmers, right, you have to separate the land and the farmer, because the farmer has the operations, whereas we hold the land. A highly common relationship in farmland, and we rent the land to those farmers. They typically pay us most, if not all, of their rent in March before they plant. And so as a result of that, the default rates and vacancy rates across the asset class tend to be incredibly low.
In theory, though, this March of 2021, what kind of recovery do you expect? Are farmers going to be able to pay your rent?
We expect so. We haven't had any default or vacancy issues so far in our company. And right now, actually, farmers are feeling good, again, because a lot of core commodity prices have rallied recently. Mm-hmm. And so they do feel good. And again, there's plenty of backstop programs behind them and subsidies for things like insurance to help their business in the bad years. Though looking forward, we actually expect them to have some good years coming at them.
Does farmland naturally depreciate at some point?
Earlier, I mentioned permanent crops and row crops. With permanent crops, where you have a tree is eventually going to die, right? Mm-hmm. And so whether it's almond trees, where the productivity curve begins to go down at 25 years, or pecans and walnuts and things where they're much longer lifespans, you still do have to assume that over time the value of that tree, even if the land underneath it is going up in value, the value of that tree is working against you a little bit.
Have you noticed any sort of land conversion where farmer land is then turned into like a building or something like that? Is that a trend that's happening?
It is at an astonishing rate. So we lose about 3 acres a minute in the United States alone. It's a staggering amount of farmland that we lose. And this is actually one of the core economic setups of why we talk about that long-term appreciation. We have so much farmland, and physically it's shrinking, and we have more and more demand every day. We grow food, fuel, and fiber on farmland, and we need all that stuff. We've got to eat. And so that's why we see it as a far less speculative asset class than much of what's going on in today's environment.
That was Carter Malloy, CEO of Acre Trader. Right now to our kicker. Elephants are on parade in Namibia. The mood, however, anything but festive. The African nation is selling elephant families as drought and overpopulation raises the risk of clashes with farmers whose crops they sometimes eat. Now the price tag, no peanuts. Successful bidders will need to cover the cost of capturing and transporting the beasts, which can weigh up to 6 tons. Now, Namibia invited offers for at least 170 elephants, and they will be sold in family groups. That does it for Bloomberg Commodities Edge. Catch me every Thursday, 1 p.m. in New York, 6 p.m. in London. This is Bloomberg.